A $2,400 tax refund means you let the government hold $200 of your paycheck every single month, gave them zero interest, and celebrated when they mailed it back in April. That's not cynicism. That's just what withholding is. A pay-as-you-go system where your employer guesses your annual tax bill and sends chunks of your salary to the IRS before you ever see it. The refund is what happens when the guess was too high. Most people treat April's refund check like a windfall. But it's not new money. It's reconciliation, evening out what you already paid throughout the year against what you actually owed once all the numbers were final. Understanding the mechanics shows why the size of your refund measures one thing: how accurate your employer's estimate was. The US. Tax system runs on current year revenue. The government can't wait until next April for everyone to pay last year's taxes in one lump sum. It needs continuous cash flow to operate. So in 1943, Congress created payroll withholding. Your employer became a tax collector, deducting federal income tax from every paycheck and forwarding it to the IRS on your behalf. This wasn't designed to hurt you. It prevents the psychological shock of owing $8,000 all at once in April when you might not have saved for it. Withholding spreads that burden across 26 paychecks. But spreading requires guessing, and that's where refunds come from. Look at any pay stub. There's a line labeled federal income tax, or FIT withheld. That number isn't random. It's calculated using 3 inputs: your gross pay for that period, the filing status you claimed on your W-4 form, and the IRS withholding tables. Basically a chart that estimates annual tax based on pay frequency and allowances. Here's example math. Say you earn $4,000 gross biweekly. You marked single on your W-4 with standard withholding. The IRS table says someone at that pay rate, filing single, will owe roughly $375 in federal tax per paycheck over the course of a year. Your employer deducts $375 and sends it to the Treasury. You take home $3,325 minus Social Security, Medicare, and state tax. Multiply that $375 by 26 paychecks. Your employer will have sent $9,750 to the IRS by December 31st. That money is gone from your possession. It's already been applied to your tax account under your Social Security number. You didn't decide to send it. Your employer did, because the law requires it. Withholding can't be perfect because your employer doesn't see your full financial picture. They know your salary, but they don't know if you freelance on weekends and earn another $10,000. They don't know if you'll pay $6,000 in student loan interest, which reduces taxable income. They don't know if you'll have a baby in July and qualify for a dependent credit. They don't know if you'll sell stock at a $15,000 gain. The W-4 form tries to adjust for this. You can tell your employer to withhold extra per paycheck if you expect outside income. You can claim dependents to withhold less if you know you'll get credits. But it's still a guess, stretched across 12 months based on assumptions that might not hold. So the IRS treats withholding as a provisional payment. Think of it like a restaurant pre-charging your card for an estimated meal cost before you order. Once you actually eat, they charge the real amount and refund any overage. Withholding works the same way. Provisional payments all year, final bill in April. Tax day isn't when you pay taxes, it's when you calculate them. You file Form 1040, which asks for every dollar you earned from all sources, every deduction you qualify for, and every credit you can claim. The form does the math and spits out your actual tax liability for the prior year. Now you compare 2 numbers. Total tax you owed, from line 24 on Form 1040, for example, $8,200. Total already withheld, from box 2 on your W-2, for example, $9,750. If withholding was higher, you get the difference back. In this example, $9,750 minus $8,200 equals a $1,050 refund. That's not a bonus. It's the IRS returning the $1,450 you overpaid through withholding. They held it for months. No interest, no apology, just a check in your mailbox or a direct deposit. If withholding was lower, say you only had $7,500 withheld but owed $8,200, you owe the $700 difference. That's the bill people dread, but it simply means withholding undershot your real liability. A $3,600 refund sounds like a victory. It's actually a signal that you overpaid by $300 every single month. Instead of having that $300 in your checking account to cover groceries, save, or pay off a credit card charging 22% interest, the government held it at 0% return and gave it back in one sum. You didn't earn $3,600. You delayed access to $3,600 you already earned. The emotional win comes from forced savings. You didn't see the money, so you didn't spend it. and now it feels like a windfall. But if you'd adjusted your W-4 to withhold accurately, you'd have had an extra $300 a month all along. Same total money, different timing. A $0 refund or owing a small amount means withholding was nearly perfect. You had maximum cash flow during the year because less was siphoned per paycheck. You didn't give the IRS an interest-free loan. That's technically optimal, but it feels less rewarding because there's no lump sum. Psychology fights math here. A refund means I'm good at taxes. It means your withholding overshot your liability. You could get a $5,000 refund and still have made poor financial decisions. Refund size is independent of whether you maximize deductions or minimize taxable income. I should aim for a big refund for safety. Withholding isn't a buffer. It's a running payment. If you're worried about owing money, that's a cash flow management issue, not a withholding strategy. A big refund just means you handed the IRS a savings account you couldn't touch. No refund means I didn't pay taxes. You paid all year through withholding. A small refund or small bill means your withholding was accurate. You settled up within a few $100s. Withholding doesn't apply to everyone. If you're self-employed, freelance, or earn 1099 income, nobody withholds for you. You're supposed to send estimated quarterly tax payments directly to the IRS. Miss those and you'll owe a big bill in April plus possible penalties. No withholding reconciliation to soften it. Some income has no withholding. Rent from a tenant, hobby income under $600, cash tips you don't report to your employer. None of that triggers automatic withholding, but all of it is taxable. Refund math only works if withholding covered most of your income in the first place. Tax credits can create refunds that exceed what you paid. The earned income tax credit and child tax credit are partially refundable, meaning if your credits are larger than your tax bill, the IRS sends you the difference. That's not a withholding refund, it's a direct payment. Different mechanism, same check. Tax withholding is your employer's month-by-month guess at what you'll owe for the year, pulled from your paycheck and sent to the IRS before you can spend it. Your refund is the government returning the amount you overpaid once your real tax bill is calculated. The bigger the refund, the more you overpaid. The smaller the refund, the more accurate the withholding was. It's not a gift. It's not free money. It's reconciliation, settling up between the provisional payments made all year and the final amount due. The system exists because the government needs steady revenue and most people can't handle a single $10,000 bill in April. Withholding solves that by making tax collection invisible and automatic. The refund is just the correction when invisible and automatic guessed wrong.